So for presenting any GSEC portfolio, let's go over the point that why one should consider government securities in the first place. So like the name suggests, these are government papers. They have a sovereign grade attached to them. So they are practically risk-free papers as the name suggests. So getting into putting any investment in a government securities will carry zero capital risk if held until maturity. These are highest safety paper. Then the second point is, if let's say we buy the investment and later on, the bond holder sees the market is doing fairly well and wants to sell out this paper, any capital gain that the bondholder gets from selling this paper again in the market will only be taxed at a 10%. Government securities, the third point is government securities, they have a range of maturity. So if one is not comfortable in putting their paper, locking their money for, let's say, 30 years and just want to go for a shorter paper, that can also be done. So the maturity ranges from 1 year up until 30 years. So depending on the market scenario and the requirement of the bondholder, one can invest in different maturities of paper. Government papers are very easy to transact, especially on bond platforms. The investor just needs to come and record their requirement, and a very simple, straightforward process for buying and selling any government securities. Also, they have government securities come at a lower ticket size. So if the investor is not, doesn't want to put, let's say, 10 lakhs or 20 lakhs, they can always go for a shorter ticket size. Currently, the yields for GSEC are at a high. So, there's low risk during the investment right now, because we are expecting the yields to come down a little, which will result in a rise in price for the paper, which will again, lead to a capital gain scenario if the investor, doesn't want to hold the paper until maturity and wants to sell it out again in the market. So we've created two portfolios for this, where we have considered, in the first portfolio, we've considered three papers. One maturing in 5 years, the second one maturing in 10 years, and the third one is maturing in 15 years. And we've given certain weights in the portfolio. So the 5-year paper carries a 50% weight, 10-year paper carries 25% weight, and 15 years again carries a 25% weight. So currently, in the current market, if an investor buys these three in these weights, the average portfolio yield the investor will get is of 7.15%. So if held until maturity, all these three papers, the average yield for this portfolio that investor will get is of 7.15%. Now, for understanding how these how this portfolio will perform in the future, we've taken in scenarios for the next 1 year. So in next 1 year, if let's say the portfolio yields changes by 25 basis points. So in the first case, we are expecting that all the yields are falling by 25 basis point, right? So the yield falls by 25 basis point. That means there's a increase in the prices of the bond. So the holding period return the investor will get for these three papers will come out to be at 8.4%. Likewise, if there is a 25 basis point rise in the yields, so the yields are rising, that means the price are coming down. So the average portfolio return will be of 5.89% for the investor. Similarly, we've taken another scenario that the portfolio one in 1 year, all the yields are changing by 50 basis points. So the yields drop by 50 basis points. Again, that will result in a price increase. The average portfolio yield will come out to be 9.70%. And if the 25 basis point is going up, the yields are going up by 50 basis points, sorry, the price will come down and the average portfolio yield for the customer will be 4.67%. Likewise, we've also taken another another portfolio. So in this portfolio, we are going a little longer on the duration. The first paper we've taken is 30-year maturity. So paper maturing in next 30 year. We've given the weight for that as 25%. 10-year paper, we've given weight 25%. 15-year, we've given weight 50%. Now, if the investor invests in these three papers at these weights in today's time, the average portfolio yield will be at 7.29%. Likewise, we've taken scenarios for the next 1 year. If the portfolio performance, how it will change if there is a 25 basis point change. So the first scenario is if there is a 25 basis, all the yields are dropping by 25 basis points. Again, drop in the yield, increase in prices, right? So the average portfolio yield will increase to 9.46%. And if the yields are going up by 25 basis points, then the average portfolio yield will be 5.16%. Second time, the changes are of 50 basis. So 50 basis yields drop. The average portfolio yield will be 11.71%. And 50 basis yields rise. The average portfolio yield will be 3.11%. So these are the two portfolios that we had considered. Again, the investor doesn't necessarily need to go for all these paper. We can always shift. We can always, change the weightage and all. This is just for understanding how the papers are working in the next year if the investor does put their money in government securities at this point in time. Thank you.
What are the risks to this portfolio? In terms of, we had mentioned that initially that G-Secs yields are high,
right?
But and they expect them to come down. But it could also mean that it could also be that they can even go higher. So what are the factors that can take them higher? Which we should be aware of.
Sorry?
Which we should be aware of. What are the risks in the portfolio?
So the risk, again, there's definitely an interest rate risk in the portfolio. In this, right now we are considering the yields to go down because they've been at a 4-year high. But again, it doesn't necessarily, guarantee that reduce in yields. The yield might not drop because of the current economic scenario in the country. And if the yield doesn't drop, so yield doesn't drop and goes up instead, the average portfolio yield will also come down, right? The holding period return for the investor will always come down. But again, if the investor has invested the money at a certain yield, that means they've locked that YTM for until maturity. So there might not be a case of capital gains necessarily in the next 1 year, but we can always hold it until maturity to get that return for any paper.
Thank you. Okay. Can close the recording, Ishna. I think we'll have to take this out. And then till that risk thing, you can keep it.
As a financial advisor, my biggest responsibility is to help my clients make the right investment choices. Now, with INR bonds, buying and investing in bonds for my clients is quick and easy. With my guidance on bonds, my clients are happy and I'm getting new business every day. Register as a financial advisor on inrbonds.com to help your clients invest and save better through bonds.